Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 296 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. We are deviating from our normal schedule of events to welcome JC Parets back to the show for a second time. So welcome back, JC. We're happy to have you.
Great to be here. Super happy to do it.
Yeah, and so for those who might be new listeners, just wanted to give some background information on JC, who didn't, for those people who didn't listen to the first podcast we did with him a couple of years ago, but JC holds a chartered market technician designation, or the CMT. He's the founder of All-Star Charts and is one of the most widely followed technical analysts in the world. All-Star Charts is a research platform for both professional and retail investors covering U.S. and international stocks, interest rates, commodities, and Forex markets. And if you're a regular listener of the show, you know that we frequently share JC's work. So before we get into our conversation, JC, I saw that you went to the Masters last week, and me being a big golf fan, that is one of my bucket list items. So can you talk about that experience really quick?
Wow. Wow. I mean, I don't even know what to say. I'm still kind of in awe. You know, I didn't get there till like 2:30 in the morning on, Friday night, Saturday morning, because I had a daddy-daughter dance, and I wasn't going to miss that even for the Masters. So I had to make both happen. So we had a great time, and then I had to fly. I got there super late, like at 2:30 in the morning, seriously. And they're all still awake, still drinking, and they're giving me pizza and wine. I'm like, it's 2:30 in the morning. We're opening a bottle of wine now? Okay, I guess that's how we're going to play it. So, I didn't get to bed till probably like 3:30, 3:45. And we were up and at 'em. You know, we were out of the house by 7:30, and they were staying about an hour from Augusta, hour or so. And I've been a sports fan my whole life. Season tickets to the Dolphins growing up, Hurricanes, Miami Heat. Like, I've been to a zillion games, Super Bowls, NBA Finals, World Series. Like, I'm not sheltered. Sumo championships in Tokyo. Like, I've been around. I've seen a thing or two. Man. I gotta tell you, the Masters is really special. I thought I knew it was a big deal, because I'm not like Mr. Golf guy, but I thought it was a big deal. But holy, wow, that is some operation they got going on, man. It's really
it seems like it. So were you there Saturday, and did you stay Sunday too, or were you home after Saturday's round?
No, we had an Easter egg hunt Sunday afternoon that I had to get to, so it was a quick in and out. I was back. I left Sunday morning, so I was really just there for all of Saturday. I saw Rory sink a putt on one for birdie when he went on to eagle, and then birdie 3. So I saw that front row. I went with a guy who invited me, who has been there every year since he was 8.
Wow.
So this guy knows every in and out, every nook and cranny in that entire establishment, and knows the move. I would have been in there like fish out of water. I wouldn't have had any idea what to do. And this guy knew everything to do, when to do it, where to sit, where to stand. Wow, what an experience I just had at the Masters. That was crazy.
Yeah. Well, that's it's definitely on a bucket list item for me. So I, grew up my whole life playing golf, and my dad's been a couple of times, and hopefully get to go with him at some point or another. And one of my close buddies actually got the chance to play Augusta 2 years ago, which is really, really special. So I know, watching it on TV doesn't do it justice, but super excited that
it
you were
looks
able to do
fake
that.
on TV. It's so beautiful. It looks fake. I can tell you, it is not fake. It is absolutely real. It is crazy. It is insane. I learned so many fun facts. Anyway, shout out Stephen Whiteso at Reveille and the whole team out there. You guys are amazing.
Great. Well, moving to a different subject, I think the last time we had you on, JC, was close to the COVID pandemic in 2020. And I think I think I started the show by saying something along the lines of, what do you think of these crazy times, JC? And you were like, Mark, aren't we always in crazy times, right? But it seems
Yeah.
like we have you on, at least a better way to say it might be in highly volatile times. So I think we have to start with last Wednesday's price action, and just want to get your thoughts and what you make of that after most of the major indices were down over 10% on April 3rd and 4th.
Yeah, I mean, listen, the plunge protection team is there. No, I'm just kidding. Hey, you never know, right? Who
Right,
the hell
right.
knows? They are, here we are studying supply and demand dynamics, and who those participants are is not necessarily our concern. Those participants are there and they're behaving, accordingly. I think the biggest thing for me as someone who studies price action is really just the behavior that you saw last week relative to the prior cycle highs in a lot of areas. When you look at the S&P 500, last week we essentially kissed the former highs from late 21, early 22. So did the NASDAQ. So did the Dow. I thought that was really interesting. Bitcoin did not, by the way. So interesting relative strength from Bitcoin. If you think that way, I guess I do. They're very similar structures. So the relative strength there is interesting. Technology as an index, the XLK retesting those prior cycle highs as well. Makes sense with its exposure to those indexes, of course. So that shouldn't be a surprise. The relative strength is in things like financials and in industrials that got nowhere near those prior cycle highs and have continued to make higher highs and higher lows. So certainly when you look at it like that, you can see who the leaders and the laggards are right away. Somewhere and then communications also retested those former highs as well. So you can put that in that same category. Consumer discretionary, large cap S&P consumer discretionary is below those prior cycle highs, right? So we're below that. So that relative weakness certainly applies there. I would encourage everyone to keep an eye on Amazon. Amazon showing some interesting relative strength right at those former highs. That's a big component of that space. I mean, it's freaking Amazon. They're in my house multiple times a day.
Yeah,
So
Amazon and Tesla, they make up the discretionary ETF, right?
that's the other one. I got very aggressively long Tesla this morning. I was already in. I bought more this morning, increasing that exposure. So I'm certainly positioned for a bounce in that consumer discretionary despite an overall underperformance, right? So I'm looking for a little bit of the rotation there. But I think just bigger picture, I'd rather stick with what's working. Look at energy, still below the 22 highs. Healthcare, still right there. Materials, below that still. Consumer staples, slightly above it, but kind of like in that healthcare sort of realm. Utilities also kind of right there. And then it's real estate, the worst of the worst, right? Real estate still nowhere near those prior cycle highs, from that post-COVID bound. So that's kind of just how I look at things overall. And then, of course, the relative strength out of China continues. That has been impressive since the fourth quarter. It continues to move higher. I think that weaker dollar probably doesn't hurt. You're seeing a ton of strength out of the euro, making new multi-year highs last week. Closing the week, you had Swiss franc making new 10-year highs. You got British pounds rolling, and then you got emerging market currencies. Brazilian real acting really well. Mexican peso acting really well. Polish zloty making new highs. So like to me, there's evidence of risk appetite out there. Philippine peso, there's some strength out there. So that helps me answer the question, hey, what should I be doing right now? Should I be spending a lot of time looking for stocks to buy, or should I be looking for stocks to sell? And I'm these days I'm finding I'm finding myself spending a lot more time looking for stocks to buy.
Yeah, yeah, that's great. And I think that might provide some comfort to some people that have been freaking out over these past couple of weeks. But I know that you look at markets and price a lot differently than normal. Your traditional fundamentalists, I guess we can call them. But based on everything that you just said, JC, what are the key assets or the key charts or ratios that you're looking at right now to determine where you think the market's going to go next?
Yeah, if you want, we can share. I could share here so you guys can see. Share. Let's see. What am I sharing? Um, just. Yeah, I mean, listen. We look at a lot of things. That's the whole point. It's like, well, what specifically? Here, how's something like this? Is good?
Yeah, perfect.
Yeah, so listen, I'm looking at sentiment. Sentiment could stay, near pessimistic levels for a long time. This comes from the fund manager survey. Half these fund managers think that we're going into recession. So that helps me kind of think about, are we actually going into a recession, right? If all these people think that we are, so I think that's interesting. Bitcoin, the relative strength that we could get above that 90, I think that that's a big one. The US dollar, it's I think that a lot of the volatility that we've seen, we talk about how this is um, we talk about how this is a volatile market, a crazy market, as we like to joke. I always say it's always a crazy market. There's always something crazy going on. But what I think increased that volatility is the fact that with the United States dollar falling, interest rates ripped. While for quite some time there, interest rates, the US 10-year yield and the United States dollar were moving like tick for tick together for a while there. So there's a lot of institutional money that's super leveraged that's tied to those relationships. So when those relationships bust, like we just saw that with the dollar continuing lower, accelerating to the downside, with rates ripping, we haven't seen anything like that in a long time. So what ends up happening is that's just the way the mechanics of the market work. It's not about the tariffs. Maybe the tariffs help spark some of those moves, but what amplified those moves is the positioning that's going on behind it. So understanding the mechanics of the market helps make a lot of sense of the quote unquote craziness. What increased that volatility, in my opinion, is that broke and yields ripped and the dollar fell apart simultaneously. So there's so many algorithms blowing up everywhere that caused increased volatility in the stock market. And you certainly saw that. So that's really what stands out to me as far as kind of like, what's sort of caused this stuff. And then I could show you some of the Forex markets. I mean, I don't want to be like Mr. Forex guy here. Here, let me
Yeah, take your time pulling it up. And while you do that, JC, I thought you said something that was pretty interesting. It was, I think, fund managers or investors, what they think the probability of a recession is over the next couple of months. And the last time we've seen these types of levels was, a good example was April of 2020, which the market had already bottomed at that point. And then if you go back to the Great Financial Crisis, it was March of 2009, and the market bottomed in March of 2009. So just because you're seeing people have their probabilities of a recession increase doesn't mean that it's going to happen. And quite frankly, you should turn around, and go on the other side of things if that's the case, and if history is going to replay itself.
No, I agree. I couldn't agree more. It sounds like you read our material,
Very much so. Very much so.
So here's the no man's land that we are in the S&P 500. So you see the volatility came right at those former highs. You see that?
Yeah.
Former resistance turning into support. You saw it in the NASDAQ. There's the highs from late 21 turning into support last week. You got the highs in the Dow late 21 turning into support last week. Again and again and again. Notice how Bitcoin staying above last year's highs. I think that's some interesting relative strength for sure. And I think there's opportunities. I look at cryptocurrencies, like Ripple stands out because it looks like none of the other ones. Solana holding in there in support. If Ethereum can get above 2,100, I think that would be impressive. Here's the technology again, like I said, retesting those former highs. And then just from a sentiment perspective, consumer sentiment is down in the dumps. I think that's great. You own stocks and you're looking to buy more stocks. We think that's terrific. Newsletter writers, getting towards extremes in terms of pessimism. Individual investors have been and remain at extremes in terms of pessimism. When you combine individual investors with newsletter writers here, you could see, extreme pessimism when you combine them both. Bullish consensus amongst the futures market completely falling apart. And then we kind of create like a composite, so we're going from some extreme complacency at some points last year to back towards the middle where sentiment usually lies. But, I think that helps set the stage of where we are in the whole thing.
Yeah, I agree. We look at a lot of the sentiment indicators like you guys do, and it seems like it's been at pretty extreme levels for the past month and a half. And we're big fans also of the Economist magazine indicator, and I think the latest one was Trump standing on a pile of cash with a $100 bill on fire. Um, and just a couple months before that, at the end of 2024, it was the U.S. dollar in a bundle acting as a rocket ship going up to space, and then you had what happened and started in December and has gone through this point. So,
I kept that one. I have quite the collection of magazines going back, to the 1930s, believe it or not, and
yeah,
I added that one to the collection.
yeah. So if that's any sign, I think the hard thing for a lot of investors to wrap their heads around, JC, is that the market is looking, 6, 12, 18 months down the road, and it's
Yeah.
not being priced based on what's already happened, right? And
Yep.
we could very well go into a recession at some point, but the market could be stair stepping higher, and people would their heads would be popping off their heads because they wouldn't, or their shoulders because they wouldn't understand what's going on. But it's so important to remember that the market's trying to price in what's going to happen in the future and not what's already happened in the past.
Yeah, and listen, if you're in the recession camp, then this is probably, you can see this chart, right?
Yeah. Yep.
Yeah, I mean, if you're in the recession camp, this is probably the biggest chart right here for you because we're in a consumer-based economy. Is my understanding from my fundamental friends, represents 70% of GDP or something like that. Is that about accurate? That's what
I
that's
would
what I'm
say
told.
so.
I try to stay in my own lane here, but I'm hearing these things. You see, I hear things. But nevertheless, consumer discretionary, obviously, the math checks out. Tends to do well when times are good, and tends to do poorly when things are not so good. And so, with the S&P 500 and the Nasdaq and the Dow and financials and industrials and all sorts of other things breaking out above the prior cycle highs and holding above it and continuing to go higher, like we've seen, this one decided to not do that and completely fall apart instead. So if you're in the recession camp, I mean, this one's got to be front and center in a recovery back above the prior cycle highs. Again, technology successfully retested this, and it's working its way higher. Communications, which is a lot of Google and Facebook and Netflix, also retested and successfully is bouncing higher. So discretionary is the odd man out. When you look at your offensive sectors, financials, industrials, technology, communications, all of them holding above the prior cycle highs. Discretionary has not. When you look at discretionary relative to staples, this is really important. You asked about the ratios. This is on an equally weighted basis. So this eliminates the Amazon Tesla dominance that the market cap weighted discretionary index has. Same thing with staples, by the way. A lot of Procter and right, like they're heavyweights. Walmart, Costco, they're pretty top heavy too. So it's not just a discretionary thing. So equally weighting both of these really smooths that out. Gives us a broader look at both spaces. And why these particular groups? Because a lot of money, just it's a lot more than you think. It's almost all of it is long only. And so these fund managers have to outperform the market. And when the market's doing well, they're gonna overweight discretionaries. They're gonna underweight staples that are lower volatility and things of that nature. And that's how they get paid, right? That's how they generate their alpha, if you will, and they get their big bonuses. On the other hand, when things are bad, they can't go to cash, right? They can't, go to treasury bonds. They have to be fully allocated at all times. That's their mandate. And so they overweight the consumer staples, the things that are going to do well or relatively well, no matter how bad things get. We're still going to drink beers and smoke cigarettes and brush our teeth and wash the dishes. I mean, that's not going to stop. So, those names tend to do better in when stocks in general are under pressure. So the ratio between discretionary and staples is really, really helpful in trying to understand the way that the market is positioned, the most dominant market, that long only portfolio manager allocated money. And the old saying is that this is the best fundamental analyst on Wall Street. That's what they call it. I didn't make that up. I'm not that clever. That's literally what it's called. This ratio, the best fundamental analyst on Wall Street, is telling us the same thing that discretionaries on an absolute basis, on a market cap weighted basis, is telling us. We got back to the prior cycle highs and failed. Here we are back above the prior cycle highs and failed. So, if you're on the bullish side and you think tech and communications and financials and industrials have it right, and they just got a little over their skis on the discretionary side, then you're looking for that reversion back above the prior cycle highs, rubber band effect, and Amazon rips higher. Right, here's a long-term look at just how important this level is. This goes back to, this goes back 20 years, right? So here's Amazon right there at those levels, right? So this is a big one. This represents 25% of the entire, depending on what day you catch it, of the entire consumer discretionary market cap index. So that's a big one. And then look at Mercado Libre. This is the Amazon of Latin America, and it actually looks better than the Amazon of America. So that's, an interesting divergence there that I wanted to bring up. And then, lastly, I did want to mention that, super proud of being the founder of All Star Charts, their 15 years. Sunday night, as a matter of fact, I just announced that I'm launching Trend Labs, and Trend Labs is really, my way of, describing and sharing with the world what I'm doing every day. I've learned for so many years the value of writing, putting ideas down on paper, so valuable. Like, yeah, I make a lot of friends because they read it and stuff like that. That's cool too. But really the therapeutic aspect of writing every day and putting ideas down on paper, super helpful. So Trend Labs is what it sounds like. It's really a laboratory to continue to build out strategies for my own personal portfolio. I've been fortunate enough to have a few liquidity events over the years. I have several portfolios. I'm 43 now. I have 3 kids, house, looking to buy more real estate, have multiple portfolios versus when I started All Star Charts. I was in my 20s, living in New York City, just trying to figure it out. So I'm a different person now altogether. And Trend Labs is really that next step, in my growth.
Yeah, that's great. No, I've been, obviously, like I said, following your work for a while and love the stuff that you put out. So super excited for this next venture for you, so to speak. So before we let you go, JC, again, I know you're not, and we're not in the business of making predictions, but with everything we kind of talked about today, in my opinion, leaning kind of bullish with the exception of discretionary and that getting sorted out. But what is this research telling you about returns for between now and the end of the year?
Yeah, I mean, listen, I think it could be choppy. I think we could keep going and potentially squeeze higher depending on how quickly discretionary gets attacked together. I think there's those possibilities. I think the end of the world and all these recessions and all this stuff, I think that stuff's off the table if these indexes are above those prior higher cycle highs. I think that's big. If they stick that like they did, maybe there's a retest. I don't know. There tends to be a lot of times. It doesn't mean that 2009, for example, never had a retest. So like there's a lot of times that there's no retest. So you can keep that in mind. But sure, it's on the table. But I think that's the big level. And I remain optimistic, about the future prospects of the market, as long as that's the case. And, things could change. So to the downside, we start taking out last week's lows on some of those indexes and sticking those lows. That's probably going to be a problem. But then same thing to the upside, right? Because we're in no man's land right now. So the question is, let's see it. So to the upside, I think there's some big ones. 5,600 on the S&P. We start getting above that. That's, now we're in squeeze territory. Dow above 42,000, squeeze territory. Q's above 500, another big one. We're above that. The squeeze is on. Bitcoin above 91, squeeze is on. So I think that there's potential on both sides. Gun to my head, which way does it go? It probably goes higher. That's the direction of the underlying trend, not just in the United States, but globally. But I'm open for whatever, I'm down for the get down, as they say. I don't think they say that anymore. They used to say that.
Back in the day.
Back in the day, way back when we used to watch television on black and white. Yeah, back in the day.
Right, exactly. Well, JC, thanks for spending some time with us this morning. Where can listeners go if they want to follow more of your work?
Yeah, at this point, I appreciate everybody's support for so many years. You could find me at trendlabs.com. Everything is there, just publishing, just a blog, getting back to old school where All Star Charts started as a blog. So we're back.
Great. Well, JC, thanks again, and hopefully we'll have you back on the show not too long and discuss some more charts with you.
Awesome. Looking forward to it.
All right, thanks.
Adios.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.